Eric Sprott, Rick Rule, and Keith Newmeyer are three successful resource investors coming together for one simple reason: to buy cheap assets from distressed companies and seize this once-in-a-decade opportunity to buy gold, silver, and other mineral projects for pennies on the dollar. First Mining Finance Corp., trading on the TSX Venture under FF, a recently launched venture with the sole purpose to acquire advanced stage natural resource projects, and starting on day one with 18 projects, management has already identified over 60 additional projects to acquire. Learn more about First Mining Finance at futuremoneytrends.com/investright.
Well, hello everyone, and welcome into crushthestreet.com. My name is Kenneth Amaduri, and we've been trying, as far as this show goes, to talk to as many experts as possible to get some clear vision as to what is going on. A lot of people are concerned about what's going on fall 2015. We got a lot of predictions out there and a lot of uncertainty in the market. So we have another expert, and we just want to get his thoughts on this. He's got a wealth of knowledge. He spends a lot of time doing research. So I'm really curious to see what his thoughts are going forward. His name is John Rubino. You're all familiar with him. We had him on the show not too long ago. He, like I said, has a wealth of knowledge. And he's an analyst, he's an investment advisor, he runs dollarcollapse.com, and he's the author of multiple books, his most recent book being The Money Bubble, What to Do Before It Pops. John, thanks so much for joining me today.
Hey Kenneth, thanks for having me on.
Absolutely. John, when it comes to some short-term predictions, I know those are tough, but based on the research that you do, what's your assessment on what's going on right now in the current economy, the volatility that we're seeing, and are you concerned about a major market move down in the short term?
Well, based on my research, which has consisted of being hugely wrong every time I try to predict anything in the short run, I would say I have no idea. You know, we've got a lot of volatility right now, and that can be traced back, first of all, big picture is that we have way too much debt, which ordinarily leads to increased volatility. Things just get crazier and crazier as you borrow more and more money. More immediately, the U.S. is considering tightening its monetary policy at a time when the whole world is over-leveraged. Asset prices are, by almost any historical measure, at levels that normally precede financial crises. And so it's not surprising that things are getting extremely volatile right now. The stock market looks like 2008 all over again, when we had these huge moves. Actually, it was 2007, and then 2008 was the collapse. But we had these massive daily moves back and forth. During that time, we're seeing that now again.
The U.S. mentioning and talking about tightening up their monetary policy. And I think it's interesting that it was just right before we started seeing all this volatility that they started hinting at raising interest rates and tightening up the monetary policy. But it's almost like now this has all happened, they can go back to kicking the can down the road, and whether or not they were actually planning on raising interest rates or not, now they don't even have to really worry about it, because they can just say, well, hey, we can't do that to the stock market and the economy now going forward with all that's going on.
Well, that's basically what happened the last few times they tried to tighten. Those things were called taper tantrums back then, when they were trying to scale back their quantitative easing asset purchases. And the markets just kind of went insane, because that's all that's propping up the global financial markets, is the world's central banks being willing to create lots of new currency and toss it into the banking system. So this is that all over again, but possibly on a much bigger scale. And you could also make the case that we've already tightened in the U.S. Fairly dramatically, because we've had the dollar go up over the past year and a half, which is in effect tightening. A rising currency is functionally the same thing as rising interest rates, because it makes it harder to pay back loans and harder to sell stuff overseas. So, and we've been seeing that lately. The dollar's up, which is a monetary tightening, and we're seeing a lot of the effects of that now with trade falling around the world and import prices going down, which means we're getting cheaper stuff from the rest of the world because our stuff is now more expensive. So we're importing more at lower prices. And equity markets and other financial markets around the world are starting to get really volatile. Those are all signs of financial tightening, monetary tightening. And so now, if we were to try to raise interest rates this month, that would be further tightening. So yeah, like you said, it's it's possible that what has happened lately provides an excuse for the Fed just to bag this whole higher interest rate thing. Or at least put it off into the indefinite future, which is what happened in the past with the attempts at tapering previous QE programs. They had to take it back, and they had to increase the amount of money they were pumping into the system rather than decreasing it because the financial markets had a meltdown. And so we're on the verge of something like that again.
John, when the Fed purchases, mortgage-backed securities and treasury bonds, it's inflationary. We all know that its QE is inflationary. Now, when China, and they've been in the news, is dumping treasuries, this intuitively is deflationary. But when a country doesn't want the U.S. dollar, that's also an inflationary sign. It's a lower demand for U.S. dollars. Do you see China dumping U.S. Treasury as inflationary or deflationary, maybe in the short term and then potentially long term?
Well, it's one of those other things being equal ideas, because as long as the dollar is strong and the Chinese central bank is selling treasuries, that's deflationary, because that's in effect it's a tightening, because they're pulling currency off the global market in return for bonds that aren't as liquid as cash. So that tightens the global financial system's monetary situation. And so, yeah, to the extent that China has to do that to support its own currency, is tightening in effect. And so that's another aspect of the global financial markets perceiving tightening monetary policy around the world and becoming more and more volatile because they're nervous about it. So I think there are a lot of reasons to be worried about the year ahead financial markets, because we're seeing instability in a lot of different places. And another aspect of this is that the emerging markets, Brazil notably among them, borrowed a lot of dollars over the past few years, because prior to the dollar spike in 2014, the dollar was relatively weak or stable, depending on the emerging market currency we're talking about. And that made borrowing dollars a good deal, because you can get dollars for a low interest rate. And then you use those dollars in your domestic economy somehow, generating a higher return than you got to pay on your dollar debt. So it's a nice carry trade. Well, but if the dollar spikes versus your local currency, you have a massive loss. And that's what's happening around the world. Especially in emerging markets, where all this dollar debt suddenly got a lot harder to handle. And that is deflationary. So basically, the key thing to understand is that debt is deflationary. The more you borrow, the harder it is to grow, and the more likely it is that you're going to tip into some kind of 1930s style debt-driven deflationary crash. And that's what all the world's central banks have been leaning against by creating huge amounts of new currency. They're trying to keep the 1930s at bay. And so far, they've done it, but at a cost of massive increases in debt around the world and increasing leverage everywhere. And so they've really made the problem worse in the process of trying to buy themselves a decade of time before the thing really falls apart.
Throughout the summer, Greece was in the headlines, and we were talking a lot about what's going on in the Eurozone. And now we're talking a lot about China and potentially what that could do to the market. But I wanted to ask you, what happened to Greece? Is that something that's just the markets and the news headlines is kind of forget about? And is this going to impact the stock market, or are we looking at China to potentially be the catalyst for a major stock market crash?
Well, if you go back all the way to the 1990s, you see we've been living in a world of crisis of the week. Something blows up and then we fix it temporarily by throwing huge amounts of newly created currency at it. And then, this began with The Mexican bailout and Russia's default back in the 1990s, when we really established the principle of the green span put, where anything goes wrong, government's got your back, so don't worry about it. Lend money to anybody, leverage yourself with derivatives to the hilt, generate those fees in the short run, get a nice big year-end bonus, and if anything blows up, the government takes care of you. Well, Greece is the latest example of that. We just basically gave them a lot of money in the form of debt relief and papered over their problems for now, but didn't actually fix anything structurally. Greece is just as big a mess as it was 6 months or a year ago. The difference being that the Eurozone guaranteed Greece's debts for a while and gave them a little extra money to pay their bills. They will blow up again, almost certainly. And now, so China has kind of eclipsed Greece as the problem of the week. And China borrowed more money than any country has ever borrowed in such a short span of time post 2007. You know, they borrowed something like 15 or 20 trillion dollars. And now they're paying the price for that because a lot of that money was invested unwisely. It's not generating enough cash flow to pay the related debts. And they've got a financial crisis domestically that they've got to deal with. So it's not clear how they get out of it, though, because that's a really big debt load. And it appears that the amount of malinvestment that flowed from all that borrowing is gargantuan, you know, and so it's not clear where China goes from here. But I think it's possible that they too can paper over their problems by devaluing their currency and creating a lot of new currency and getting out from under their debts, but at the cost of more turmoil in the financial markets. You know, when you do something like that, you replace a debt crisis with a potential currency crisis. In other words, if you're creating a lot of new currency to pay your debts, maybe people don't want to hold your currency anymore. And so that's the risk that China runs, that they're going to have instability in the yuan going forward. And then, you know, when China's papered over and we stop thinking about that, Japan or someplace will probably blow up. They've got astounding problems there. You know, they've had the most aggressive monetary policy the world has ever seen in the last 3 years.
It's a domino of problems across the world, with just country after country dealing with this issue, and, you know, the world dealing with ultra low interest rates that cannot go up unless we deal with just an implosion across all the different markets. So, John, being that it is uncertain what exactly is going to happen, how do you play this? I mean, how do you hedge yourself? Are you short the Dow and long gold? I mean, do you make that sort of call? Are you bold enough to do that, or do you hedge yourself a little differently and just maybe stick with one side of the trade that's a little safer and position yourself that way?
Well, the thing that works best in the last 2 weeks has been something called a volatility spread, where you just bet on things bouncing around a lot, and it doesn't matter which direction it goes, you make money. So it's not clear that that's going to be the play for the next 5 years or whatever, but I think volatility is probably something worth betting on going forward. And you can do that in a variety of ways, with options markets or with really aggressive equity kinds of positions that are hedged, so that if they just sit there, you lose money. But if they spike in one direction or tank, and then you make money. Anyhow, that's what a trader might be looking at right now. In the longer run, I think precious metals win out in these kinds of chaotic environments eventually, because people just get so terrified and so mistrustful of government policymakers who clearly don't know what they're doing, you know, that eventually people go back to the old forms of money that have for 3,000 years pretty much held their value. So you'll see a lot of money flowing into precious metals at some point. It's not happening today.
Right. I mean, in a deflationary environment, we could see gold go lower. And do you have any thoughts on that as to how low it could potentially go, or do you see it maybe just staying, flat or just trending up?
Yeah, I don't really know where the bottom would be in gold if we tip over into a 1930s style debt-driven deflationary crash. But I tend to think the governments of the world won't let that happen because you can't stay in office during something like that, right? You get thrown out of work if you're the premier or the prime minister or the president of a country who's going through something. So all the governments of the world are going to at some point realize that the only way out from under all the debt they've taken on in their past 30, 40 years of extreme stupidity is to devalue their currencies really aggressively. And so I kind of tend towards Jim Rickards' scenario of a coordinated devaluation against gold, where we go back to some form of a commodities-based monetary system, but after an aggressive devaluation, so that going forward, there's not much inflation, but we have this huge burst of inflation while the devaluation is taking place. And so that, to me, seems like the most likely scenario given human nature. In other words, sitting politicians are always going to go for inflation rather than deflation if they have the choice. And unlimited printing presses in the hands of the world central banks give them the choice. So I think that's more likely.
You mentioned human nature, and we're doing this interview right now. It's 9/11, and I kind of expected there to be a little more volatility in the markets than we've seen today. It hasn't been that unusual in terms of what the stock market is doing at the moment. But is there potentially a hidden buyer? I remember watching the stock market when we had that 1,000-point drop in a day, and then it went up almost 1,000 points. And that day, in my mind, I was just like, who in the world is buying at this moment for it to make that sort of a move? And I'm curious because there's a lot of specific dates that people are predicting crashes on. And because of human nature, there could be a lot of selling on those days. And do you think there's a hidden buyer waiting for these events to occur that would potentially counter a stock market crash in these times?
Well, I think we've got governments around the world intervening in all the financial markets. So it's not a surprise when huge amounts of buying come in at the peak of a volatile move, because governments are terrified of the financial markets spinning out of control because they're so over-leveraged. So in the U.S., you got the plunge protection team. In Japan, the central bank is aggressively buying equities, and in China, they're overtly doing it. They're saying they're doing it, instead of hiding the fact. So it's not at all a surprise that you see governments trying to smooth out the moves in these formerly free markets. And in the short run, they're able to come in and push things through technical barriers that then bring in the hedge funds that are looking at these technical buy and sell points and do the work for the government so that they can move markets around very easily at the margins. But the cost of that is ever increasing leverage in the global financial system and the diminishing of the ability of markets to send accurate price signals to players out there. What markets do, and I think governments don't seem to get this because they're acting as if they don't get it. The main characteristic of a market is that it's a price signaling mechanism. It tells you, if you're an entrepreneur or consumer, what to do. Because if the price of something is going up, build a factory to make more of it. If the price of something is going down, buy more of it because it's getting cheaper, and we don't have that kind of price signaling anymore in the global financial markets because governments are in there intervening for domestic political reasons. And you get, when you don't have this kind of accurate pricing signal, entrepreneurs and consumers make the wrong decisions. They don't know how to figure out what to do anymore, so they do stupid stuff. And that's what we're seeing around the world. And the result of that is what economists call malinvestment. Things that should never have been built, purchased with money that never should have been borrowed. And so, the Chinese ghost cities are the most glaring example of that. But it's everywhere. Americans are buying more and more cars with 7-year car mortgages, and that's patently absurd because a car is a depreciating asset. So you lock yourself into a 7-year loan on the car and you're kind of hamstrung for a really long time. You're not going to go out and buy a new car in 3 years. So that future demand has been moved to the present at the cost of slower growth in the future. And then that's where we are as a global financial system. We can't grow because the markets have been hamstrung by government intervention, which has led to huge amounts of malinvestment, which basically pulled future demand into the present, which means the future is slower than it should be, which leads to more intervention, and we're in a kind of a death spiral.
Yeah, that credit crunch, the credit crunch that you're talking about, and based on everyone I'm listening to and the research that I'm doing, could be pretty substantial. And I think that's what we're going to see when it comes. It all implodes on itself. It's going to be that credit crunch and all the money that people think they have in their real estate and think is available to them for them to go out and purchase cars and essentially have jobs. I mean, it is going to come back in the very near future, and I don't exactly know when that's going to be. But John, in conclusion, for a lot of the people that are concerned about the imminent future, do you have any words of wisdom for them to help them be able to sleep at night regarding what's going on? What can they do to position themselves and feel relatively confident about the future in this volatile market that we're in?
Oh, I don't think there's any way to feel relatively confident in this kind of a world because it's so volatile. I would advise someone, and don't take this as investment advice as much as a general mindset that I'm advising you to adopt, is to be very conservative, to understand that things are going to get crazy. They're already crazy. Look at what's happening in the stock market and extrapolate that out for a few years. That's the environment that you're going to be living in. So take the steps that you can take to be as self-sufficient as possible and as financially secure as possible. Pay off your debts if you can, and become as self-sufficient as possible, or not self-sufficient, but indispensable as possible at work. Become the person who's going to be the last one to be fired when things get really crazy, and invest to the extent that you do invest in things that have tended to hold their value over long periods of time. Don't go for growth stocks in this environment, even though it's completely possible, it's feasible that growth stocks could be great in speculations in the next couple of years, but they're not really investments in this kind of an environment. Whereas physical precious metals held in a safe place, that's money that you can be reasonably sure that over the coming decade will hold its value. And so that will allow you to sleep at night, even though those things could also bounce around in the short run. And, a well-chosen piece of real estate that isn't too highly leveraged might also be something that is more stable than the average stock portfolio and also the average bond portfolio. A lot of the things that your financial planner will put you into based on the premise that they're safe, are not going to be safe anymore because the bond market is the epicenter of government manipulation and therefore is going to get extremely volatile when things really start to spin out of control. So that bond fund your broker told you would be safe for the next 10 years could easily go down by 30 or 40%.
Yeah, the safe investments aren't so safe anymore in this new economy. So, John, I really want to thank you for coming on the show with me today. If people want to reach out to you, I know that you got some books. You have the website, dollarcollapse.com. And I believe you have another company you're associated with as well. I haven't had a chance to talk to you about it. Would you like to share that with us?
Yeah, I'm working with Bearing Asset Management now, which is a money management shop dedicated to protecting people from the kinds of crises that we're discussing today. And I run dollarcollapse.com, and my most recent book is The Money Bubble. So that's available at dollarcollapse.com or on Amazon or in most other online bookstores.
Thanks so much, John. Have a great day.
Thanks, Kenneth. You too.